Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and it's earnings season. So we're going to take a look at some of the Q3 earnings over the next coming days and months. We're going to start off with Vici Properties Incorporated, ticker VICI. This is a pretty large holding of mine. I have a little over 100 shares of the company. It is down quite a bit, and that's mostly due to the cyclical nature of real estate dependent stocks in a high interest rate environment. So now that the Fed looks like they're going to hold interest rates as they are, we've seen a decent recovery in these stocks. And as they lower those interest rates, we'll see those cyclical stocks, the real estates, the cars, the things that people tend to finance because they can't strictly afford it, bounce back very strongly. We have some expectations for the year in column F, and in G, we have what we've actually seen year to date off of this earnings report. So we have the percentage to goal. We'd be hoping to see something around the 75% mark, higher than that for some. If it's something like expenses, lower than that. But we'll get right into it and see how things are going. Revenue-wise, right on the mark. Looks like they're going to hit that 3.5 that we are expecting from them this year. And their expenses are down 45% of that goal of 643. They had huge expenses this last year, which kind of drove our expectations up a little bit, but it looks like they are not going to have such large expenses this year, and probably are going to come in shy of 6 unless they do some large acquisition of some sort. So that does bring down their expenses as a portion of revenue to 10.84, which is really good. We do want to see that lower. That means that they're able to keep more of that revenue, have it go towards the business. That is a very good number. We saw back in 2021, they came in at 4.3, in 2020, 25.48, and back in 2019, 5.29. So it would be nice to see them back in the single digits, but is a lot better than that 18% that was expected this year. A net income attributable to shareholders, 1.7 so far this year. That is above where they should be on trend. They're beating expectations by 6%. And you can see down here, the margin, they're coming in with an almost 66% margin when we were only expecting a 61. So things are doing a lot better, which is definitely something nice for a company that's been trading down. So I almost want to buy more. Earnings, they're a little shy on earnings per share. I think it'll be fine. They'll make it up in the fourth quarter. Otherwise, they might just fall within a few cents of that 242 that's expected this year. Average basic shares. They have consistently grown the share count. That's what it's like in the real estate space, where they're able to get money rather easily just by issuing more shares. And it's helping them to pay back investors through their dividends. Common stock equity is growing. It's ahead of pace, so we should be closing out this year around 31, if not higher. For assets, they are continuing to grow them. They're up about $5 billion from where they sat at the end of last year. I'm not quite sure that they're going to hit this goal here. That'd be $11 billion in a single quarter. So it looks like there might be a bit of a slowdown on those assets, which means we'd hope the same for the liabilities. For those, we are seeing them move from 15.3 up to 18.3. So a $3 billion move. And they're likely not going to hit this either, with the expectations of this year being lower than 21.7. That's $3 billion more than where they stand. So they might even come shy of 20 here. And that's what we're looking like. And that's what we're looking at for the earnings. So everything looks good. There's nothing that's too concerning there. If we take a quick look at the summary, we see that currently shares sit at $29. We have a fair value of $43. So right now, with dividends included, it's looking like the fair value in 3 years is going to be 73% higher than where the stock currently sits. So very strong returns, almost three times what the market is giving. And over the next 5 years, we'd be looking at 78. So there is a bit of a slowdown in that time period, only 5% over the 3 to 5 year gap there, but still outperforming the market significantly by 31%. I mean, quite a bit of that is the dividend. It is a REIT, so a lot of the value comes from that dividend. And the average return based on this thesis here is 8.5%. And we just saw that there's a bit of a slowdown in the assets and the liabilities. So even if we cut that in half for the both of them, one of the main drivers there is also that asset growth. So if we cut those down to half of what they were, that return does fall significantly to nearly half of what it was. You're still seeing market-beating returns over the course of the next 3 years, 5 years, almost in line with the markets. So that is something to keep an eye on. If it is a huge slowdown in that asset growth, then there may be a bit of cause for concern there. But let's hop over to the actual earnings report and see what they have to say about the company. As you see here, we have the third quarter earnings report, and they do have some highlights up here. So revenue grew by 20.3%. It's exactly what we're looking for, 20% year-over-year growth to $904.3 million. Net income attributable to shareholders, we already took a look at, and that breaks down to a per share value of 55 cents. Up from 34 this last year. AFFO, very important for a REIT like this, the adjusted funds from operations increased by 16.4% year over year. And on a per share basis, it increased by 10.7 because they did issue some more shares. So that is something to keep an eye on. I mean, if that is growing by more than 10%, things should be good with the stock. You're getting a market-beating return with the average in stocks being 8 to 10%. So that is the big number to keep your eye on. 10.7 is really good. They issued 5.1% more shares than they had last year. And then they get into their acquisitions and such, which we'll talk about down below. Quarterly dividend growth of 6.4%. So that did slow down a little bit. It had been 8-9% growth over the past few years. And they ended the quarter with $510.9 million in cash and cash equivalents and $807.2 million available equity proceeds. So they're increasing their AFFO guidance from 2,170 million to 2,180 million, which is $2.14 to $2.15 per share. The CEO had some comments. He said that this quarter reflects our sustainable commitment to accretive growth and capital deployment through the acquisitions and strategic financing activity, exemplified by approximately 20% revenue growth and nearly 11% growth in AFFO per share year over year. Subsequent to the quarter end, we entered into an experimental sector with Bowlero, the market leader in reinvigorating the programming and economics of the bowling experience through their innovative consolidation and growth model. In this partnership, we acquired 38 Bowlero properties and concurrently bolstered our embedded growth pipeline by obtaining a right of first offer to acquire current or future Bowlero real estate in the coming years through sale-leaseback transactions. We also expanded our presence in 11 new states and added another publicly traded tenant to our roster. So that's really good news too. They're definitely diversifying. They started out with casinos, then they went to wilderness retreats, and then they went international, golf. Now they're going bowling as well. So they are definitely focused on money-making entertainment, which is something that you can't quite put online like retail. So they have some detail on the acquisitions and portfolio activity down here. They finished their Rocky Gap casino resort transaction for $203.9 million in cash. And they also acquired 4 real estate assets from Century, Alberta, and Canada. They had talked about this in the last earnings report. This cost them, by the end of the deal, $162.4 million based on the exchange rate. And then they talk about the Bolero, 38 bowling alleys for a price of $432.9 million. And they're going to lease those out for $31.6 million for a cap rate of 7.3%. So that cap rate's not the best, but I'm sure it's decent in the current economic environment. More details on the common stock outstanding. We had put that into our spreadsheet, so we already saw all of this. They have grown their share count by 13% over the last year. And then some breakdown on the financing. So they've got some revolving credit. The higher interest rates, anything above 5%, I'd consider to be pretty high. So they do have some notes due this year, quite a bit, at 5.625%, 5.75% down here due in 2027, a smaller amount. And then down here they have 2032 and 2052, also large. So this is something to keep an eye on. Quite a bit of this debt is in the 4% range, which definitely isn't bad. As for their guidance, they increased their guidance. So their AFFO, their updated guidance is now for 2,180. We had touched on this earlier, up from the 2,170. They are expecting to issue more shares than previously. We see that moved from 1,011.7 to 1,014.4. And everything here moved up at least a little bit. A balance sheet. We had already pulled the numbers, but the leases make up the bulk of it. Sale type net leases. Finance leases are another large portion of it. And essentially between those two are the balance sheet. Then there's a little bit of investments in loans and securities. The land is honestly rather small portion, and then the cash and cash equivalents. So for liabilities, just a lot of net debt, and that makes up almost all of it. And then other liabilities that we don't get too much detail, which is likely all included within this. So we already dug through their debt quite a bit. Shareholders' equity is growing. It is up 9% from where it sat last year at the same time. And then we get into the actual financials. So revenues are to date up 3% from where they were last year. So within the first 3 quarters, they already made more than they made in total last year, which is really good. Expenses, we already touched on how they're a lot lower than they sat last year, a third to almost a quarter of what they were. And then we come down to an actual breakdown of where their revenues are coming from. And we can see the largest portions here are Caesars, so definitely those Vegas casinos that they own. So these 2 Caesars leases make up almost half of their contractual revenues. Then they have the Mandalay Bay lease for another pretty large portion, the Venetian, Hard Rock Cincinnati, Southern Indiana, and then this is that Canadian lease that we had seen, Margaritaville. So across all of this, it does look like they are very centered around Vegas casinos for their leases. And the nice thing there is they're not the ones that are actually running the casino. They're just renting out the space. So regardless of how the casino does, they owe rent to Vici. Almost regardless of what happens, Vici should be able to make it through just about anything that happens here in the future. So with all of that, it's definitely piqued my interest a little bit more. I think that I might need to buy some more of this because it's very cyclical with the interest rates. And right now, if we're at the peak of those rates and we're towards the bottom of this stock, I see no reason not to at least make my position a little bit larger. So I want to thank you guys for watching this one. Please like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.